Welcome, everyone, to this episode of the Expansive CEO podcast. I am your host, Hannah Chapman, and today is Thursday, July 24th. It is currently 1:16 p.m. on the Pacific coast side of the U.S., um, which means we are in for another Investment Friday to be posted on July 25th. And I'm going solo today. I don't have Brad with me. So I will be going over a little bit of an educational topic. We're going to go over some of what's going on with the markets this week and this past week, and we're going to talk about a really common topic that comes up with a lot of my clients and that you might be having questions around too, which is, should I leave my old pension or employer plan alone, or should I roll it over into an IRA or other appropriate um, investment account rather? And the answer always depends on your situation, your family, your expected longevity. There are so many different factors to consider. So we're going to talk about that. And first, what's going on in the markets? So this week we are actually seeing some new highs in the markets. Nasdaq, the S&P 500, these big indices that we tend to follow have all hit record highs yet again. And why is that happening? A piece of that is because a few trade deals went through this week. There are more trade frameworks, rather. We don't really know all of the details of what these trade deals look like. But we did have some different things come through between the Japan, the EU, the Philippines, and Indonesia, so that we might have a little bit more clarity on trade with those countries. It's been interesting listening to some of the tariff and trade back and forth because China has also been pretty loud with its trading partners, um, telling them not to put together deals with the US that negatively impact their trade relationship with China. Um, and so, there's these different countries, Indonesia, the Philippines, have been really walking that line of, okay, how do we maintain these different trade relationships that are really important? So that is interesting. We're still seeing what's to come with China. We don't know for sure, right? We have the framework in place, but we don't have the actual details. So we'll keep waiting. But the market did respond really favorably this week to, the fact that, again, we've got stronger, not deals, but stronger knowledge of what the trade deals will look like with Japan, European Union, Philippines, and Indonesia. So we have seen that. We are also still waiting. So last week we talked all about the Fed and a lot of the structure of how the Federal Reserve actually works, what the FOMC or Federal Open Market Committee looks like. And we are still waiting to hear, they haven't had their July meeting yet. So we'll find out what that's going to do to the market next week, July 29th and 30th. They'll have their meeting. The expectation is still that we'll probably just keep rates the same. That's what most analysts are expecting. So we'll see if that happens. And if the Fed does come out and make any changes to the interest rate, we'll just have to see what the market says. Sometimes, if the market is expecting that we're going to keep rates the same and not decrease rates, if the Fed does come out and decrease the rate, sometimes that can cause a market sell off because, that means the Fed thinks the economy is doing worse and that we need to lower interest rates and we need to, start making that change right now. And so we'll see, right? And if they keep it the same, maybe that means business as usual. But we will just wait and see what's happening next week. So, not a lot else going on this week. We've got some, you know, bigger stocks that have made some moves. Tesla, for example, had a pretty good sized drop this week when their results came out that their, second quarter was not great. They have had a lot lower sales um, and deliveries of cars recently, which is not super surprising given all of the turmoil that they've been experiencing this year with Elon Musk being, really out there in the political sphere and not really jiving with the base of consumers that typically buy Teslas. So that one wasn't super surprising. We'll see what happens with that. But really, not a whole lot else going on. And that's pretty typical for this time of year. In the summer, it tends to be, we've said this before, but the summer tends to be kind of volatile in general, and the trading is thinner. Meaning there's less trading. So there are literally less trades, fewer trades that are happening in volume across the different indices, just in general, because traders are out for the summer. And what's really funny, I like to mention this every year just because people have heard this before and it bears repeating, but the old saying of sell in May and go away literally comes from the time in the early 1900s when the traders, so most trading was done in New York City, and they literally worked on Wall Street. They were in buildings together. There's no central air conditioning, right, at that time. So it was super hot, and everyone would literally stop selling and leave and go to the mountains for the summer. So they'd be gone from May to September. So they would sell in May and go away, literally leave the city. No one was placing any trades during that time. And then they would come back in, late August, early September and get started again. And so that is a holdover from, that time, but still, different people go on vacations and, trading is just generally thinner, less volume during the summer in general. So we don't have a whole bunch of, market update other than just we're going to be volatile for another couple months. And that's very, very typical for July and August. So I'd love to pivot over to this question about should I keep my pension where it's at or should I roll it to an IRA? Being a CFP, certified financial planner, my job is always, always, always to look at someone's full financial situation. And then, if I have a suggestion or a recommendation, I will make that based on what is in their best interest and only in their best interest. So for the very first piece ever is that if someone is not a fiduciary and they are telling you that you really should roll your old 401k, your old pension, anything into an IRA with them, and they're not a fiduciary, which, again, a CFP is a fiduciary. I have to work in my client's best interest at all times. You would hope that those people are not just trying to get a paycheck, but it is very common or has been very common, that people in the industry just want to get that rollover, just want to get those assets under management. And that it's not always in your best interest. You really have to take into account all the factors in your particular situation to know if that's right for you. So I'm going to say that first and foremost. So all the stuff that I'm going to share with you today, you can take it into account. You can think about it. And then if you have a financial advisor and you have an old plan that you found, this is a great conversation to have with them about all the pros and cons as to why it may or may not be beneficial for you. And if you don't have a financial advisor and you would like to talk to one, you know where to find me. You can go to the numeral 2 wealth.com and find me there. You can jump on my calendar. We can meet, see if it's a good fit, all that fun stuff. So, first things first, we're going to talk about mainly about pensions. And so you might be listening to me and thinking, Hannah, like who on earth still has a pension in the year 2025? Well, what's super interesting, and I mostly work with entrepreneurs, right? I work with a lot of entrepreneurs and business owners. And so again, like why are we talking about pensions? Well, I have multiple clients literally right this moment who are making this decision, who are considering what they want to do with their old employer plans. And so many people are in this boat that they have old employer plans. So who still has a pension, right? Let's think about all the places that still have a pension. The federal government. So I have several clients who have what's called FERS, F-E-R-S, the Federal Employee Retirement System. So they'll have a pension through FERS. I also have worked with lots of people who have been in the teaching system. And so they have pensions through their state teachers retirement system, which is usually some form of STRS, S-T-R-S, or a state employees retirement system, SERS, something along those lines. And then beyond that, I also have clients who have worked for corporations that do still have a pension, or maybe 10 years ago still had some pension. And so they have a little bit of a pension benefit. So that would be, employers like GE, for example, if someone still has a GE pension, or what was another one? I can't remember the other one. I was just looking at Avon, I think was the one I was looking at recently. They don't have a pension for new employees, right? So if you get hired this year, or if you got hired in 2020 or in 2018, yeah, you didn't get hired into a pension system. But if you worked there in 2010 or in 2005 or in the year 2000 or before that, and you left, you may still have a balance there. So, first of all, my very first recommendation is to think back to all the jobs you've ever had and just recall, where did I work? Did that place have a pension that I might have forgotten about? Why do I say this? Literally, again, literally have clients who told me just in the last year, like that I've worked with for years, and we've uncovered all kinds of things, and we've done tons of different stuff together. And, you know, through, just not knowing literally everything about their life, they come back to me this year and they're like, oh, hey, by the way, I have a whole pension that I forgot about. And here it is. It's like, let's put it in the system. Like, well, that is amazing. Congratulations on finding that much money, because that's super cool. And also, now we get to have this conversation. The other piece is that most employees who, especially those who are, let's say 50 or younger, who have a pension sitting around in an old employer plan, I really haven't met very many people who fully understand what that pension looks like, and what it looks like today, and what it's potentially going to look like in 20 or 30 years. Most employees or business owners now, clients that I work with, don't have a really good grasp of what that pension is supposed to do, what benefit it's supposed to actually provide, in dollar figures, and how long it's going to last, all of those things. So if you don't know what that looks like, that's totally fine. And that's an educational piece that you might need to research together. It might be helpful if you can sit with your financial advisor, if they're a person that you can sit with and look online and like actually go through your pension information together and piece it together. That's great. You might also be able to call and talk to someone in the benefits department of your old company to find out more about how your pension will actually work. So, core question here: should I keep my pension where it is or roll it over to an IRA? So, the first piece here is that you have to find out if you are able to take a lump sum distribution from your pension and roll that over to an IRA. Typically, there should not be any taxable event that happens if you roll your pension from where it's at now into your retirement account because you're not taking any current income. So there shouldn't be any tax implication. Um, but, and I'm going to put a big, asterisk here. Again, you have to really look into your plan. Some employers have both a non-qualified pension and a qualified pension. Non-qualified means non-tax qualified or non-retirement account, right? So it doesn't have a preferential tax treatment. That's a non-qualified pension. The qualified pension does have that preferential tax treatment. It can go into an IRA. Okay, so you might have some different pieces of a puzzle depending on what your puzzle looks like. For most people, and so for anyone in the federal retirement system or a state teacher's retirement system or a state employees, any of those types of pensions, these are typically fully qualified and they are eligible to be rolled into an IRA. So, what would be the reasons why you would want to keep a pension, right? So, what does a pension do? A pension is uh, it's a payment for life, is what it is. So, let's say you are 45 right now and you have a federal employee retirement system pension that is going to pay out $2,000 a month when you reach age 65. Well, in the federal employee retirement system, you're going to get that $2,000 per month for your whole life. That's how it works. So when you're 65, you can start taking that pension. And if you live to 75, great. If you live to 85, great. If you live to 95, great. Like it's going to pay you $2,000 a month for your entire life. If you have a spouse, let's say you're married right now, you plan to stay married, and you pass away. Let's say you start taking your pension at 65, you pass away at 85. So you received your $2,000 a month from 65 to 85. Well, when you elect to take your pension, you can also choose to have spousal benefits that pay your spouse after you pass away. With the FERS system in particular, just in case you're listening and you have that system, they allow for either 50% or 25% of your benefit. So just for round numbers sake, let's say your full benefit amount, if you took it just for your own life, was $2,000 a month. And so you can choose $2,000 a month and you get it through your life. And then when you die, it's done, it's gone. There's no other benefit. But if you take a little bit of a reduced amount, let's say it's $1,800 a month, you could choose to do $1,800 a month. And when you die, your spouse gets 50%. So instead of $2,000 a month, you get $1,800 a month. You take it from 65 to 85, you pass away at 85, and your spouse is still alive. Now your spouse gets $900 a month going forward. Okay, so that's just purely an example. If you were to do the 25%, that benefit would be a little higher. You'd probably get like $1,900 a month. And then your spouse would get 25% of that, or let's see, $475 a month after you pass away. So there are these different, we call them joint survivor annuity amounts with pensions, right? So you can take it for your life, or you can choose to protect your life and your spouse's life as well. So this is a great option for stable income during retirement. The only thing that you'd have to be aware of is like, are there cost of living adjustments, and are those cost of living adjustments going to actually keep up with inflation over time? Okay, so that's a big piece. A lot of them do. A lot of teachers' annuities or pensions do have cost of living adjustments. And if you've ever been a teacher or have ever known teachers, there are also real possibilities, and it happens every once in a while. Like if the state doesn't have the budget, they will sometimes cut benefits for teachers. And there's big contract negotiations that go into that, and all of the stuff that goes with that. But with the federal government as well, those things can be modified or changed in the future. The next piece, why would you want to keep a pension in place? It's definitely simpler, right? You don't have to do anything. You don't have to manage any investments. The pension fund of either your company or the state or the federal system, that pension fund is being managed on your behalf. It is invested. It's like, make no mistake, that money is invested. You just don't have any access or choice with it. Someone else is managing it for you. The next, like, the main reason that people really appreciate pensions is, again, that they can't outlive that money. So if the market is up and down at any time, doesn't matter, because the pension fund is being managed much more conservatively than a typical, individual's portfolio. We'll talk about that in a second in more depth. But for the most part, when you're in a pension, as long as the pension is solvent, they will continue to pay for your whole life. And lastly, the creditor protection that is available, especially with government and state pensions, they typically have some very, very strong legal protections in place, to where if something does happen to the pension, another agency is going to come in, step in, and take over. So there are absolutely reasons to keep that pension in place. What are the cons then? Let's flip to the other side. Why would you potentially want to roll? So if, like, you're listening to this, you're like, well, then why would I ever, like, not want that stable income stream? Why would I not want to do that? The main reasons why you would want to think about rolling, and again, just so it's super, super clear for anyone else listening to this podcast, this is not a recommendation at all. This is purely for educational purposes so that you can look at your own plans and make a decision that's right for you and talk with your financial advisor. But why are the reasons you might want to, move to an IRA rather than keeping the pension? So, one thing that I look at is that, especially with younger clients, so we'll say, especially in that, 40, 40-ish, between 40 and 50 age range, or 30, plus, there aren't as many 30-year-old clients I have with any substantial pension, or in their 30s. Right. But I've definitely seen some clients in their 40s who have, maybe a lot of decent amount of military service. And so they have a large FERS balance, or they were a teacher for quite a while. So again, they have a pretty good, STRS type balance. So with that, if you have a balance in there and you're fairly young and you're in your 40s and you plan to work for another 20 years or even 25 years, the way that pensions are invested, they are invested to keep a promise. They are promising you, they are guaranteeing you that you will have a certain benefit in the future. And that means they have to be able to deliver on that promise. So they are not swinging for the fences when it comes to their investments. They are much more conservative in nature in their investments in pension funds than you would normally be as a 45-year-old who still has 25 years to work. Right. So for me, okay, I'm 40, I'll be 41 soon. All of my investments are super aggressive. I have a high risk tolerance. I know I'm going to be, not taking that money for quite a while. So everything I have personally is invested aggressively. And again, not saying anyone else should do that, just that that's how I invest my portfolio. Most people in my age range that I work with are at least moderately aggressive, meaning at least an 80% equity and 20% fixed income portfolio. If that is your stance, and if you believe that the market's going to go up over time, that will have ups and downs, but ultimately, over the next 10 years, over the next 20 years, over the next 30 years, the market will be higher than it is today, and you're invested aggressively or moderately aggressively, that is quite a bit more aggressive than you will see in a pension fund. So you will not be getting an internal rate of return from that pension fund typically more than in the 5.5 to 6.5% range. That's going to be the the main target that most pension funds are going for. So if you think about that and you're like, man, if I only got 6% or 6.5% every year, I would be kind of bummed about that because I have a lot of time on my hands, right? To before I retire. I mean, that's how I personally feel about it. But for some people, they'd be like, no, I don't want that. I don't want that low of a return rate. Other people who see that and are like, oh, it's a guaranteed, 6.5% return rate. Yeah, great. Keep it there. Okay. Again, you have to put your situation into perspective here. The other piece of that is that you can't really change what's coming through that pension. It's got, again, somewhere in that usually 5.5 to 6.5% return rate. Some of them are even lower. Some are in the 4.5s. It just depends. We can do a calculation to run that. But you know, you don't have the choice to say, I want that more aggressive. I'd like for that to be higher later on. It just is what it is. To deepen on that just a little bit, that's one of the conversations that I typically have with my clients is, okay, well, what would happen? Say you're 45 right now. What is the lump sum amount that's available to you? So we take a look at the lump sum amount. Let's say the lump sum amount that you could take today is $37,000. And you could take that $37,000 out of the pension and plop it into your IRA and let it grow. Or you could let it sit there for 20 years and then it'll be, a base of $97,000 then at age 65. And it'll start an income stream from that point, right? I'm not going to give number examples because I don't have them in front of me. But that's pretty typical. So what would we do? We would then run a calculation. We can run time value of money calculations that will give us how much we're going to expect, like how much rate of return, what is the rate of return you would have to get on that $37,000 to equal what you would be getting from the pension. When I talk about that 4.5 to 6.5% range, that's exactly what I'm talking about. So that's just math. We can do that math, right? As long as we know what's your current lump sum, what's the amount that you would be expected to be able to take when you are 65 or whenever you can start your pension. And then we run the rate of return based on that and the future payments. Okay. So you don't have to worry about that math. But it's a fairly straightforward calculation. So that's what we're basing this off of. Next, the next really important piece, and when I talk to clients about this especially clients with children, this tends to be a really important piece. So death benefit limitations around pensions really make a big difference because if you were to, let's use our example before. If you have a pension that you'll receive $2,000 a month starting at age 65, and that's the highest amount you can get. And let's say you don't have a spouse. Okay. If you don't have a spouse, and you're 65 and you start your pension and you get $2,000 a month. Let's say you have two kids and you want to leave something for them. You want to have, you know, something there for them when you pass away for your kids, whatever that looks like. If you have that $2,000 a month pension and it's going and you're receiving it and that's great, and you pass away at age 70, then you only received that 5 years of pension, right? So even if we do that math, 2000 times 12 times 5. So you've got $120,000 from your pension over that 5 years. When maybe, they were expecting that to be double or triple or quadruple that over your lifetime, right? Like that's what the pension company had actually planned for. Well, if you died within 5 years, great, it's done. That's it. There's nothing else. There's nothing that goes to your children from that pension because they're not your spouse. They're not going to be a survivor of that pension. So that piece is really important to a lot of people that I've spoken to personally. So even if you have a spouse, right? So let's say we did that other example and you only live for, let's say, I mean, sometimes it's really sad. I mean, it could be like 2 or 3 years and suddenly like that's it and you pass away. And then your spouse then gets that reduced amount, right? So then your spouse gets a reduced amount for however many years that they live. And then when they pass away, it's gone. There's nothing to leave to the children. Where on the other side, if you roll that money into an IRA, if you had chosen to roll that money into an IRA when you had the opportunity, that money could keep growing. And if it's in a traditional IRA, and it grows and it grows and it grows, and we're hitting those milestones, right? It's growing faster than that. We'll say 6.5%. Maybe you've been averaging 8 to 9% over the years. You now have a bigger pool of money that you can pull from if you need it. But if you don't need it, you also don't have to pull from it. So your spouse, when you pass away, your spouse can then just assume your IRAs. They can just become the owner of those IRAs and they can continue to grow. And then when your spouse passes away, if they have not used all of that IRA money, it gets passed on to your beneficiaries. So if you have children or if you have other family that you want to leave money to or different charitable causes or groups, they get the benefit of those funds rather than the pension companies simply just stopping, right? Because that's part of the calculation that is happening on the end of the pension side is that, most people will not live much like too significantly past the, Social Security average ages. So Social Security does um, surveys every couple of years to update their actuarial tables, which tell us like if you are, 60 now, what's your life expectancy? An average life expectancy in the US is still right around age 83 for men, 84 for women. In general, I haven't looked it up. It could be different than that. But it's been right around that like early to mid 80s for quite a while. So most pension companies are banking on the fact that a lot of people are going to pass away before then and they don't have to pay out any more benefits. And so the few people that do live longer, right, they will pay them, but it's going to be very few people that they have to pay for that long, if that makes sense. They're doing these calculations. The other piece, so that was death benefit limitations, super important piece to talk about. The next one is employer solvency. So solvency risk or employer risk. So with the federal government, with state governments, there are some pretty important protections in place for those plans. But corporate pensions can be different. Corporate pensions have in the past gone under. It's very it's a big deal. It's usually in the news when it does happen. But then, that does tend to very heavily affect the people who have been, living off of those pension dollars for a long time. There is a form of insurance that can come in and help make the participants whole, but it's not usually completely, like, they're not going to receive 100% of their benefits going forward if the corporate pension becomes insolvent. So, um, that is a piece, that is a risk of keeping your pension in place. And then lastly is the inflation risk. So if you don't have a cost of living adjustment on your pension and it's just we'll use that $2,000 a month again, $2,000 a month 10 years ago is very different from $2,000 a month today, right? Like, you can literally buy half as many things today as you could have 10 years ago with $2,000. We have just been through a period of extreme inflation, right? That compounded and made things quite a bit more expensive over the early 2020s here. But that's not to say that that couldn't happen in the future. So if your pension does not have a cost of living adjustment, that is something to be very wary of. So when you do make that decision, if you decide to roll over to an IRA, or rather, like, what are the benefits of rolling over to an IRA? One, you can decide, like we said, you can decide how you want to invest those dollars. If you're a moderately aggressive or an aggressive investor, you can go into the portfolio of your choice, and you could potentially see a higher average return. Next is the flexibility, right? So with that $2,000 a month, that's great and that's steady, but it's always $2,000 a month. You're not ever going to get anything different from that pension. And once you start it, you're locked in literally for life. Like, you're making a lifelong decision when you sign your pension paperwork to start receiving your pension. If you roll over to an IRA instead, you have that flexibility that if you need the money, you can take it out. If you don't need the money, you can let it keep growing, right? That's a huge piece. The legacy planning, like we talked about, right? You can actually plan to leave that money to your heirs or to the beneficiaries of your choice, rather than have just the one annuitant plus survivor method that happens with a pension. And then a big one for a lot of clients too is simplicity and consolidation. That, having all of these different pieces out there. So if you have a 401k from an old employer, and then you have an IRA over at this institution, and then a simple IRA over here at this other place, and then a pension over at this other, that starts to be really overwhelming, and it's hard to keep track of. And it's hard to make sure that your all of your accounts are doing what you actually want them to do and invested in the way that you want them to be invested, right? So having a comprehensive financial plan is really helpful. You'll be able to see, when I do plans with clients, like, we can see where all of their investments are. We can see where everything is, keep track of it. But again, I'm telling you, like, even with that, I still have clients, after a year or 2 years or 3 years, be like, oh, hey, look, I found this. I forgot about it. And I found this other, $50,000, $100,000 plan. Like, again, celebrate. Awesome. It's amazing. But you would be surprised at how often that happens. The other piece to consider, if you are thinking about, okay, well, maybe I should roll this to an IRA, or nope, I'm pretty comfortable with my pension, is, do you have the ability to stay calm through the financial ups and downs, right? That's what it means to, either, if you are a really stable investor, that's great. And I have met people who are wonderful at this and who have done a really, really good job over a lot of years of, like, nope, I just put my money in, I save every month, I'm good. I know it's going to go up and down, and I'm okay with that. For Most people, though, and most of my clients, they really do need someone else to be that calm factor, that calm investor that helps keep their money more stable so that they're not making emotional decisions. So if you are someone who is very nervous about the market and you do your own investing, having someone else, having a big pension fund manage that for you, that could be an important piece for you to consider to just let it let it stay over there. So those were what do I want to say? Um, when we are looking together at should I leave this pension or should I take it? Again, those are some of the really big pieces that we're going to look at together. So that's going to be your life expectancy and how healthy you are, how healthy your spouse is, how long did your grandparents live or your aunts or uncles, if you're a woman, the women in your family, if you're a man, especially the men in your family. Let's look at those. What are your other income sources? Are you going to plan on Social Security? Do you have other 401k savings in place? Do you have a business with recurring income and passive income? All of these things really matter. Um, then we've got the inflation protection and cost of living protections. Do we have any of that in place? We want to really look at that. Do you need financial flexibility? Do you need to be able to take withdrawals more than what the pension says per month sometimes and less other times? Do you have estate goals? Do you want to leave a legacy for your children, for your beneficiaries? And then your risk tolerance, and your stability with investing, right? So those are some of the really big things that we want to look at for your particular situation. If it makes sense to roll the pension or keep the pension where it's at, roll it to an IRA or keep it where it's at. So that's what I wanted to go over today. And again, just because I've literally talked about it recently with three different clients, which is kind of a lot, when we're looking at what's coming up and what's happening, just in general in the world that people need to be talking about, or thinking about that might affect who we are, what we're talking about at any given time. So I want to leave it there. If you have any questions, if you have not looked recently, if you have, jobs in the past and you haven't checked just to do a sweep to make sure that you don't have any other 401k or pension stuff hanging out, I recommend that you do that every once in a while. You never know what you'll find. And if you have any questions, if you've ever had this conundrum come up and you want to talk about it, or if you've ever had someone tell you, like, oh, I think you should, without really like, I think you should roll this over without going through your full situation, and seeing if that's actually what's best for you and your family. Yeah, just know that it should never be a decision that's based on what's going to get the advisor paid, right? And if you feel like that's what you're being pushed into, just be really aware of that and know that you don't have to say yes. If you're not comfortable, if you're feeling like pushed into something, just say, hey, you know what? I want to take a pause on that. I don't really want to talk about that right now. And just, yeah, decide if that's a relationship that you are comfortable with. But there are definitely pros and cons on either side, but it should always be a decision that's really, really based on what you need and not pushed in any way. It should always be presented as, here are the options, here are the pros, here are the cons. I might have a professional recommendation for you, but it always, always, always should be what's in your best interest. So if you have any questions and you would like to hear about not your specific situation, but if you have specific questions, you can send them to me and I would absolutely love to address them on the podcast. And you know where to get me. All of that is in the show notes. You can get me at Hannah, Hannah, at Expansive CEO for the podcast. And you can visit x2wealth.com for more information about investment planning, retirement planning, financial planning in general. All right. Have a great week, everyone, and we'll see you next time. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.